Hey traders, welcome back to another workshop. So this workshop, let's discuss what is a flag versus a rollover. So this workshop has actually been made in our the 1%ers Trade Club. If you don't know, you can head towards our link in the description below. I actually run a community where I personally educate some of the traders to become self-sufficient. But yeah, flag and rollover, both of them are very similar pattern. There's one question that's a very common question where my Trade Club members ask me and say, hey Neil, a flag and a rollover looks very identical, but how do you know flag is going to become a continuation pattern while rollover is going to become a reversal pattern? How do you identify whether if it's a flag, if it's a rollover? So let's go to the chart and let's talk about what is a flag. So let's discuss. A flag is what we call a momentum ignition or a continuation pattern. There are two different versions. One is obviously the bull flag, one is obviously the bear flag. So what is the logic behind a flag? So imagine on the uptrend, on a strong uptrend, we got buyers trying to push price higher and higher and higher and higher and higher. At one point, the market, the big players, the retail traders, we need some sort of resting period. We need a pause, a period where we either take off profits or we reassess, are we going to continue going long or not? Because no one has unlimited resources, unlimited purchasing power to say, I want to keep buying and keep buying and keep buying. Eventually it will stop because human perception on value will change according to the range, right? The further it goes, our perception will change from worth it to not so worth it to extremely not worth it. But what makes a flag continue pushing price higher or lower is the fact that when we form a period of consolidation, which is a period where the big players actually take off profits, because big players are the only people that can push the market. So I want all of you to get this correct first. Simple logic behind price action is that retail traders never will have the ability to move the market. It has always been the bigger players that have the power to actually manipulate or move the market. So why do you think price paused there? It's because when price pause means the bigger players start taking profit. That's why price pulls back, because their buy orders has to be sold back to the market in order to close profit, right? So you can imagine the logic behind it. So when it forms a period of consolidation means the moment it drops, there are still a lot of people trying to buy back into the high price, which means people are willing to pay for a premium, paying for higher bids in order to participate in the market. That's why price tries to return, but a lot of people are still trying to defend it. So if the bigger players don't jump onto the buy, very high chance they'll miss out a bit of the move, because the market is about big players versus big player. So if let's say the market stops at 190, 162, let's say for example 190, 162, and we have institutions A, we got institutions B, both of them are trying to get into the market, right? Because they clearly know it will go up. Why? Because they have the market too, they have the ability to move the market. So both of them are actually snatching better price. But if let's say institution B is realized that the market is about to go up, what do you think he is likely to do? He will start disregarding the price point and start saying that since price can still go up for another $100, getting here is not bad, because if I don't get in here, high chance price will still move, because institutions A get a lot more shares. Then institutions B, all of a sudden their shares, nothing gets filled, so they have to participate as well. It's a perception of value that makes price keep going to one direction. All right, when price keeps going higher, forming bull flag, continue to push, means people are paying for a premium. So on the flip side, it's the same thing. So we got sellers keep pushing the market lower and lower and lower, and at one point we have what we call a resting period, which is a period where people either have to reassess the value of the price, or people are starting to take off their profit from their short position. So when everyone's hesitating, when everyone is speculating, when everyone's taking off profit, what's happened? Price pause. it forms a period of consolidation. And at one point, when the market still find consensus that people are willing to sell despite selling at a lower price, then it will eventually continue. So that is a flag. A rollover is basically an exhaustion pattern that I tell my trade club members, hey, you all need to know how to differentiate a flag and a rollover, because a rollover will be a lot more lengthy and it looks a little bit more linear from the lower time frame. Later on, I'll give some of you, all of you, some example. A flag, if you zoom down to the lower time frame, you'll see an non-linear price movement, which means we have a period where price doesn't respect support and resistance. So it looks like this. All right, if, let's say this is on the 1 hour, so assuming maybe this is on the 4 hour. On the 5 minute, you'll see price do this, pull back deeper. On a bull flag scenario, all right, this is a bull flag. So why do you think the majority will actually lose money here? Why do you think market, the bigger players purposely create this phenomenon, this pattern? It's because when price break through the price swing low, retail trader go short, they get stopped out. All right, people who go long here get stopped out. They'll go short, go stopped out. So the cycle repeats for a very long time. That's how the bigger players are able to get more liquid as well. All right, so in order for them to move the market higher, they have to make sure people sell. So what is the best way to make people sell from a retail trader perspective? Is to make sure they create false scenario that looks like price is about to drop. Then when everyone hop onto the sell, they buy back to the market. All right, makes sense. What I'm trying to say here is not about how big players are trying to manipulate the market, how the whole forex market is rigged, but this is just how the financial market works. It's all about psychology. It's all about testing your mental, testing your understanding of price behavior, understanding of price response, price action. So a rollover is basically when I call it a high quality rollover when price break through a, let's talk about a bearish reversal, right? Bearish reversal means we have an uptrend, price seems like it's breaking through the high, and everyone, what happened? Jump onto the buy, then we have a period of stagnation, which leads to a much impulsive reversal. So on the lower time frame, what does it look like? A lot of times you will see price do this on, let's say this is on the 1 hour. On the 5 minute, maybe you will see a price action like this. Assuming it broke through the high, you start seeing price do this. So what's the difference between a rollover versus a flag? If you zoom down to the flag on the 5 minute, what are you going to see? A period of non-linear consolidation, which means we don't respect SNRs. We don't respect lows or highs. Market is basically trying to sweep both ways to make sure they gain as much liquid, as much share as possible. But for rollover, what's going to happen? You see price have periods of failure. Failure means we try to form a bull flag, try to continue, failed, try to go back up, failed, eventually it leads to what? Some very linear, maybe lower high, low low sequence on a bearish rollover, or vice versa. If let's say price is doing this, then you'll see something like this, a very linear high low on a bullish reversal. Make sense? So one of the very good example will be Euro Aussie right now. So I just found a perfect example. So you see here, ignore the time frame of this, right? If you drop down, so on a 1 hour or on a daily, sorry, we know that price has broken through a fresh high at 166.93, right? Which is this key level. We all know that, all right? So instead of talking the daily, we talk about the 1 hour. So what happened on the 1 hour? We have a period of price breaking through this key level, push up, and then what happened? Price tries to go back, we form a linear resistance. Because when price breaks through fresh high, I want all of you to think about the logic, right? If it breaks through fresh high, it is supposed to continue from a basic supply and demand logic. If sellers are gone, price is supposed to go higher. But if let's say price break through a fresh high, but it doesn't find enough momentum, bullish momentum to go higher, what does that tell you? What it basically tell you that nothing will ever send price higher. See that? Period of linear resistance, support become resistance. See that? Right? Support become resistance. And then guess what? The moment when we clear this low, we just completely melted. Okay, so I'll give you an example of a bull flag. All right, a bull flag, we have a lot of them on the lower time frame, something like this. Looks really beautiful. So put on a replay mode and drop down to the 15-minute, or maybe on the 5-minute, right? On the 5-minute. So can you see? A flag is a period of consolidation, but in a non-linear market structure movement. Do we respect any support and resistance? Never. See that? Price break through the low, go back up. The moment it goes back, it definitely stopped out most of the retail trader. Go back down, everyone's chasing the short, then guess what? Everyone trying to sell here, then price reverse back up. All right. A flag is basically when market is in a period of pausing, when market is in a period of resting, it needs some time to decide its further direction. So that time can be utilized for the bigger players to actually take off profit or add on more size. So how can they possibly add on more size? Is to make sure the retail trader are being fooled. We can say this, right? Because majority of retail trader, we don't have enough education, we don't have enough knowledge to actually understand what really is a flag, what really is a rollover. That's why that will be pretty much it for this workshop. I try not to go too long, because if I go too long on this topic, it would be pretty it would be at least half an hour to 1 hour. So that's it for today's workshop. I hope all of you understand what's the difference between a flag versus a rollover. So this is an extremely important topic for all of my Trade Club members. I want all of them to understand what is the difference between a flag as a rollover. At the same time, I want all of you who are supporting my free channel on YouTube or Telegram to also understand what exactly is a rollover, because this is a term that I always talk in my channel, also to my Trade Club members, right? And I'll talk to you later. Bye bye.